Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. As we emerge from the shadow of the virus and global economies get back on their feet, there's a growing realisation that society can begin to live with the virus in the months and years ahead. This is allowing policymakers for the first time to consider withdrawing some of the vast emergency stimulus programmes that they've put in place in the last 18 months. Lead among these, of course, are the central bank bond purchases under QE programmes. Three things, though, are complicating this delicate exercise. First, of course, world supply chains remain under extreme stress. What began as problems in semiconductors, lumber and autos is now a worldwide crisis in the gas and electricity markets. Secondly, China is at risk of its own deflationary problems in the property market, as we've seen from the Evergrande crisis. Third and finally, in the run-up to COP26, climate commitments are going to intensify, and this will be very disruptive for parts of industry and the energy supply chain. Markets are clearly negative. Nervous. The MSCI World Index is down 4% this month, and UK bond yields are rising by 30 basis points as bonds around the world sell off. We'll look in the slides ahead at what this means for asset allocation and what this means for our policy update. So let's begin by looking at the broad contours of this post-pandemic landscape. First of all, I'm afraid these elevated inflation rates we're now seeing are going to be sticky. Expect rolling supply shocks of the sort we're now seeing in gas and electricity markets to become something of a norm. Secondly, expect governments to continue with their growth at any cost fiscal agenda. Austerity is firmly off the menu, and there will be a tearing up of the rule book in many areas of government debt restraint. Thirdly, the levelling up agenda is going global. A real worry about social, wealth and income inequality coming out of this crisis will dominate government thinking. Fourthly, the climate agenda, of course, is set to take centre stage and will guide really all industrial policy and put a particular squeeze on many areas of the old economy. Fifthly and finally, expect policymakers and politicians to be really determined to make this an inclusive employment recovery, looking for jobs for minorities, for the low paid, for women. And to achieve that, I think, they'll be prepared to tolerate a higher inflation rate going forwards. So what does this mean in terms of growth numbers? We've updated our own GDP forecasts here. And while we've downgraded China and the US modestly, we've also upgraded Europe. Overall, in that bottom panel, we've taken global growth down from 6.1 to 5.7 this year and 4.4 to 4% in 2022. Now, those are slightly weaker numbers and the data's coming out a little softer, but remember those are extremely robust rates by any historical measure, and they're quite enough to power the earnings and dividends of our underlying companies. So where are the risks? Well, firstly, on the downside, I think the risk lies in China, particularly with the property sector. We've seen, of course, this crisis at Evergrande, the country's second largest developer. It has a staggering 123,000 employees and 3.8 million contractors, and its $300 billion balance sheet represents 6.5% of the total liabilities of China's property market. What is facing is an industry-wide problem as Chairman Xi's government clamps down on excessive leverage and speculation in the sector. But it's still worrying. Look on the right-hand side, that red block showing the proportion of the Chinese property market in 70 cities where prices are actually falling. It's widening. Expect some policy support, expect a modest loosening of rates, some injection of cash into markets, and I think an attempt by the state to manage this drawdown. But of course they've tread a delicate measure between moral hazard and of course bailing the sector out. The second risk, of course, is right to the other end of the scale, inflation, as we see rates rising around the world. On the right hand there, you can see the US up at 5.2%, the UK at 3%, they're probably 3.2%, they're probably rising to 4% in Q4 and Q1. And look at Europe, up at 3% already. We've just had a new number out this morning, 3.4%. And in Germany, inflation rates are 4.1%, a 30-year high. Now, some of this effect is base effects, distortions in the numbers coming out of the crisis. But as you can see on this chart, underlying supply problems that are going to be with us for some time are clear. Look at the surge in shipping costs up nearly fourfold. UK baseload electricity up more than twice from its pandemic lows. And of course, on the right-hand side, we talked about it before, this surge in second-hand car prices up again, really distorting the whole car market around the world. And these factors, I think, are going to play into this permanently higher inflation number. So how do investors react? Well, of course, they've had the most extraordinary run. I've shown here the S&P 500 corrections from peak, that's that dotted line. You can see the trauma of 1929 in dark blue, 2000 in light blue, 2008 in yellow, and compare that to the extraordinary rapid recovery we've seen today. Our question, of course, is can that continue? Against these risks, what are we doing in our portfolios? Well, we're continuing with that strong underweight bonds to really reflect the inflation risks around the world and the extremely negative real yields. We're thinking this still makes equities comparatively attractive. Yes, valuations are high. Yes, risks in some areas have increased. But dividends are robust. There's real value in the emerging world, and earnings numbers are coming in ahead of expectations. So we're remaining modestly overweight. Keeping our overweight in alternatives, as I've talked about before, a precautionary position in gold. There's a lot of room for policy error by central banks, and infrastructure renewables tied in to the COP26 agenda. Finally, though, a substantially overweight cash position, really to manage risks and to have some dry powder if some of these issues and challenges as we come out of the crisis cause sharp drops in markets which we can take advantage of. Well, I hope that's helpful. Thank you so much.